Hello there. Welcome to retirement planning in United States. Okay, let's begin. Um, Imagine you have a paycheck of this much, and then your employer gives you a 401k account. What is a 401k account? So 401k refers to line 401 section K of the IRS tax code, and so it describes that an employer may choose to set up a 401k retirement fund account for its employees, and therefore this is optional. Employers can choose not to do this. If your employer has a 401k account, then great. Okay, and so let's go on. And so the moment you join the company, the employer would say you have a 401k account, go into your account and configure how much money from your salary you want to throw into your 401k. And so maybe you configured, okay, I'm going to dump in this amount into my 401k every month. And depending on how generous your employer is feeling, they may choose to match your contributions. Okay, and this is usually a ratio of what you yourself put in. The more you put, the more the employer matches it. Okay, and so this is called the income contribution limit. And so your income contribution to the 401k is $23,000 in 2024. Okay, so in 2024 your income contribution limits to your 401k is $23,000. This does not include your employer matching. Okay, this is solely from your contribution, $23,000. You can front load, you can take a portion of your paycheck or proportionately across the year. It's up to you, and the employer will match another amount. And so the total amount you can dump into a 401k every year is income contribution plus employer matching okay, plus further contributions. What does that mean? We will get to that later. Cannot be more than $69,000. But if you are over the age of 50, this limit is now $76,500 a year if you are 50 plus. Okay, old people. And so this entire thing combined has to be under this limit. And so if you have $23,000, say your employer matches about $5,000 to it, and so you get $5,000, and that's $28,000. You take $69,000 minus $28,000, that'd be $41,000. Maybe to reach this limit. Okay, beyond that you cannot contribute anymore. And it is important to note that the only way you can contribute to your to your 401k account is by income. You cannot use a cash contribution or top up or whatever. You have to configure it to come from your paycheck. Okay, there's no other way to do it. That's how 401k works. And within 401k there are several types. Okay, there's pre-tax 401k, there is Roth 401k, and there is after tax. Okay, and so pre-tax and Roth is something that you can configure when you choose how much from your paycheck to dump into your 401k every month. And so you can choose, say, 50% of this amount goes to pre-tax, 50% goes to Roth. So what's the difference between pre-tax and Roth? Pre-tax, otherwise known as traditional 401k is what the name implies. When you contribute to this pre-tax account, you do not pay tax on it at this moment. It is deducted income, is deductible taxable income to the IRS for the tax year. But when you reach the retirement age of 59 and a half years old and you start taking it out, you'll be taxed on the full amounts that you withdraw. Okay, so it's more like a deferred taxation. Whereas Roth is whatever you contribute here, you still pay tax on it. Okay, but after you dump into Roth and then use it to invest in stocks, funds, or whatever, you no longer have to pay tax on it when you withdraw. Okay, so let's say you dump in $1,000 now into Roth, you pay tax on the $1,000, but forevermore, as it grows and grows and grows and accumulates interest and dividends, whatever, and grows to $2,000. When you withdraw after 59 and a half years old, you do not pay tax on the withdrawal. It is amazing. After tax is one of the most useless things in 401k. After tax is like Roth, whereby whatever you contribute from your paycheck, you still pay tax on it. And the difference between after tax and Roth is that you still pay gains. You still pay tax on the gains when you withdraw after 59 and a half years old. And so it's like, why are you throwing money in if you can just invest in a brokerage outside instead of locking it in your 401k account? Well, there are some advantages to do this. One of which is that after tax, whatever is in your 401k cannot be seized in a bankruptcy lawsuit. And so if you declare bankruptcy, the debtors cannot come and take your 401k. It is protected against bankruptcy. So that's one reason why some people might want to do after-tax contributions. And so how do you contribute to pre-tax, Roth, and after-tax? So when you configure your income up to $23,000 a year into 401k, this $23,000 can only go to either pre-tax or Roth, not after tax, okay? And so this $23,000 plus this $23,000 can go to either pre-tax or Roth, and any employer matching amount would go to pre-tax. This depends on the plan that your employer set up with the financial institutions. So 401k is privately owned, and it's a plan that your employer set up with private financial institutions. So every plan with every company differs, and it really depends on the institution, okay? And so one 401k is not the same as another 401k, which means when you change companies, like when you jump from A to B, now you have 2 401k accounts. If you change companies again to C, now you have 3 401k accounts. Well, if you don't want to have so many 401k accounts, you can actually file some form whereby you can transfer all of your prior 401k accounts to the current 401k accounts, or you can even withdraw it to an equivalent characterization IRA. This is not the IRA that the rest of the world knows. This means individual retirement account. We will get to that later. And so this $23,000 from your paycheck in the pre-tax and Roth, after it's maxed out, if you want to continue contributing up till the maximum limit of $69,000, or if you're more than 50 years old, $76,500, you can configure more of your income to go into after tax, and only into after tax. Okay, you cannot dump into this after the 23,000 limit has been hit. And so why would anyone want to do that? Well, there is this thing called a mega backdoor. A mega backdoor Roth. And so the loophole here is that you can configure your accounts to dump in more money beyond the $23,000 into your after-tax 401k account. And then after it's in, you do an in-plan Roth conversion. Okay, in-plan Roth conversion such that the after-tax is re-characterized into your Roth account. Why is this allowed? We have no idea, but Congress says it's a-okay. Yeah. And so what you can do is that you can save your paycheck into either pre-tax or Roth, and then after that, beyond this amount, you can continue dumping in more money depending on what the difference is. 69,000 minus your 23,000 minus the employer matching, that is the amount you can dump into after tax. And then if you're using Vanguard has an automatic conversion plan for you. So because whatever you put into after tax, you still have to pay tax on the capital gains, which means if you dump money inside and you gain an interest or dividends, or the stock went up by like $50, when you do an in-plan Roth conversion, you have to pay tax on the gain itself, which means it benefits you to convert this from after tax to Roth as soon as possible. And certain financial institutions have wisened up and allow some automatic operation, to immediately dump it into Roth for you. If you are using Vanguard, they have this. It's amazing. If you're using Guideline, what is Mega Backdoor? I have no idea what you're talking about. And so this Roth conversion can convert to what? Either Roth 401k or Roth IRA. So this is slightly more inconvenient because this is a totally different account. This is employment-based 401k. This is private owned. You open this with a bank, with a financial institution. You can even open it within the same account with Vanguard or Fidelity or whatever you're using, okay? And so this allows you to dump in money and never pay tax on the capital gains forevermore. Amazing. And so this is your 401k. Now let's talk about IRA. IRA, same as 401k, has traditional IRA. And there is Roth IRA. So as the name implies, just like the 401k, traditional is pre-tax IRA. Whatever you put in, you don't pay tax. You defer it until you withdraw it after your retirement age of 59.5 years. And then your Roth, you pay tax up front and you never ever pay tax on it again when you withdraw. Great. Okay, so think of this as like saving some money, and this is saving even more money. Got it? And so not everyone can contribute to an IRA. Let's just talk about the limits for now. The IRA in 2024, a year, you can only contribute out of pocket $7,000. If you're above 50 years old, you can contribute $8,000. Okay, but there is an income limit to using an IRA. If you're too rich, you cannot use an IRA. What I mean by this is that for traditional IRA, there is an income limit of between $77,000 of your adjusted gross income to $87,000. And so if your annual adjusted income is below $77,000, you can contribute to a traditional IRA up to $7,000 or $8,000 if you're above 50. And then if you earn more than $77,000, then it's a partial deduction. Okay, if you're earning less than $77,000, whatever you contribute to here is fully deductible for the tax year. However, if you earn more than this but less than this, it is a proportionate reduction of the limits that you can contribute. It is a proportionate reduction of the tax that you can deduct, taxable income that you can deduct. Okay, so there's a difference between the income limits for traditional and Roth. I'll get to that later. I'm not sure why it's so simple, it's so easy. But this income limit, if you're filing jointly as a married couple, is $123,000, and it starts phasing out until you reach $143,000. Okay, and so what happens is that if you have $7,000 contribution limit to traditional, and you are earning say $82,000, so $5,000 more than this, so right in the middle between this range. So what happens is this is proportionately reduced by half, because 5,000 more and the total range is 10,000, so it's half. And so you can contribute up to $7,000 into your traditional IRA, but you can only deduct $3,500, which is half of this. Does it make sense? Okay, so now remember, traditional IRA income limit adjusts the adjusts the taxable income for deduction. Okay, whereas the income limits for Roth, okay, this is traditional. Okay, the income limits for Roth IRA is different. It's between $146,000 to $161,000 if you're filing single, or $230,000 to $240,000 if married, filing jointly. Okay, so the Roth is different now. Roth is basically saying that if you're filing single, if you're earning less than $146,000 adjusted gross income for that year, you can directly contribute to Roth up to $7,000. If you earn between these two amounts, the amount you can contribute to Roth IRA is proportionately adjusted down. So this isn't even about deductible taxable income. Okay, this is about whether you can even put in money in the first place. And so this limits how much you can put into IRA. This limits how much you can deduct from your taxable income. Different limits. Okay, and so if you earn more than $161,000 if filing single, or more than $240,000 married, then you can only you cannot contribute to Roth. But there is a thing called backdoor Roth IRA. Okay, what this does is, since you earn more than this, but you are not prevented from contributing up to the limits to the traditional IRA, you just cannot deduct it from your taxable income. And so you do this, you dump in $7,000 here, and then you do in-plan recharacterization, in-plan conversion to Roth. This is allowed. So you still pay tax on your traditional IRA contributions because you are earning between here or more, and then you pay tax on it, you transfer to Roth, and you never ever have to pay tax on it ever again. This is called the backdoor Roth IRA, and this is called mega backdoor. So mega backdoor because it's a way larger amount than this, right? So this is how you save even more. Now let's go to the HSA. HSA is health savings accounts. It is only allowed if your employer provides you with HDHP. HDHP is called the High Deductible Healthcare Plan, and this is what was introduced in Obamacare, or ACA, Affordable Care Act. Okay, so it is a high deductible. After you pay that deductible out of pocket, you have to pay a copay, lower copay, or if your employer is generous, you don't have to pay anything again. But you have to sign up for an HDHP insurance in order to qualify for HSA. Does it make sense? Okay, so you can, if you do this and then you have an HSA account open for you, now you can directly contribute from your income, or you can do a cash top up out of pocket separate from your income. If you do it from your income, this will be reflected in your W-2 form, and you don't have to declare it on your tax form because W-2 already has it for you. This you have to separately declare on the tax form, okay, your 1040. Whatever you put in the HSA, you can leave it as cash or you can invest them. And so whatever you put in is tax deductible from at least at the federal level, okay? And so whatever you put into HSA, you can deduct from your taxable income, but there are two, and then you can do that the same for the state's tax. There's federal tax and the state's tax, okay? But there are two states that don't recognize HSA as tax deductible income. And so those two states are California and New Jersey, because they don't like you, okay? And so if you're in California and New Jersey, whatever you put into HSA, they will treat as ordinary income and still tax you on it. And all of your capital gains and interest that you gain in HSA, you have to annually report to the states of California and New Jersey to file the taxes. It is incredibly complicated because of these two states. Otherwise, if you're in any other states, screw this too. It's deductible from your taxable income. Okay, and then you can use this to pay for anything you want. Okay, can use it to pay, any medical bills you want. You can do it for Invisalign, you can do it for medical checkups, dental cleanups, dental cleanings, eyewear, new glasses, anything you want, you can pay with this. And so this is how you save even more money. And this is how you save on taxes. Unless you have children, and then you open a 529 plan, and this is to save up for their college savings. And so if you do this,